Hey guys, welcome back to another video on the channel, and today I'm here to talk about the best option trading strategy. So this is an options trading strategy that I think is by far the best in terms of performance, profitability, and just working long term. So if you do enjoy this content, be sure to like and also subscribe to the channel. We're almost at 200 subscribers, so I'd very much appreciate if you did both of those things. It'd be very thankful. And yeah, let's get right into it. So the strategy that we're talking about today is a poor man's covered call, also known as a PMCC for short. So what you do with this strategy is you buy an in the money call with 90 plus days to expiration. That's up for discretion. You can buy it however long you want, and then you short and out of the money call with over 60 days to expiration. So resulting in this position is a spread in which the long call is in a longer term expiration than the short call, a diagonal debit call spread. So what I wanted to show you guys is the strategy in action. So this is kind of just like a base case. So you can see that in this example, your max loss and your max profit are both capped. So your max loss is not infinite, and your max profit is also not infinite, and your break even is $95. And you can see that $105 is your max profit, and your max loss is, somewhere down there. So the thing that is interesting about this is that you can't make more than a certain amount of money if the stock shoots, if this stock that is $105, you already made your max profit, goes up to $200 all of a sudden, you're not going to make a dime more. And that's because you're selling a covered call, saying basically the call that you're buying is you're buying 100 contracts to buy the company at that price of 95. As you can see here, the break even 95. So you're buying $95 contracts as calls, and then you're selling $105 calls, saying that you're willing to sell the stock if it hits this price. So if it hits your price where you're willing to sell it, and you have the calls for 95, so you had the stock at 95 and now you're willing to sell it at 105, you're going to make some good money. So an example that we can see right here is SPY. So SPY, we're buying a call that's in the money. And this is just an example, so I didn't want to make it too complicated. We put the expiration day 5 days out. So you're buying an in the money call for $5. Or not $5, it's $5 a contract. It's $509. So this is an in the money call, and this is what it's like if you just buy it on its own. You can see the max profit is unlimited, and your max loss is the price of the contract. So your contract could go to zero, or SPY could hit $1,000 and you could make a lot of money. You can see SPY only has to go up 2.5% for you to make $1,153. Very quick. A lot of money could be made right there. But so you can see SPY is this is a stock that has a lot of volume in their options trading, and this is one that you can probably make a lot of money with options. So if you want to turn this into a poor man's covered call, you'd buy this in the money call, and then you'd sell a call against it. So now you can see, look at the way that the graph changed in the, almost bottom right here. We can see that the max loss was capped and the max profit was unlimited, and the max loss was $509. Now the max loss is $174, so that got more than cut in half, and the max profit is $126, so that also got more than cut in half. But we can see that SPY only has to rise 0.33% for you to hit your max profit. So SPY has to make a very small move for you to reach your max level of profitability, which, is probably going to happen. SPY is probably going to go up 0.33% in the next 5 days. I like the odds on that play. I think that that's very likely to happen. And you see that you have a very tight window now. If the stock goes down 0.33%, you're down money. If the stock goes up 0.33%, you're up money. So it creates a tighter window, but it means you just have to be right, but you don't have to be as right. For a call, if it trades sideways, you're completely done. But this, if it trades sideways, you're kind of not, that messed up. It's not that bad. The value won't really go down because you have the covered call protecting it, you're protecting the downside, and you can see that your max loss is a lot less. And your break even is, SPY going up a little bit, but not that much. And then this is actually a play that I do myself. This is Amazon. This is 47 days out. So you are supposed to buy it in the money. This is pretty much in the money in my opinion, $225, and the stock is $224.95. So if you bought this $225 in the money call and then sold a call against it at $230, which is a delta of under 50, Amazon's price would need to go up 2.24% for you to be at your max profit. And in the next 47 days, with how the market's been going, do I think Amazon is going to go up 2% in the next 47 days? Yes, I think they will. And this isn't very expensive to open. So this is how you can get a lot of exposure on these big stocks like Amazon, Nvidia, Meta. These stocks where the options are crazy expensive. You need to, if you didn't do a poor man's covered call on this, it would be $1,000, $1,200 to open this option. But because you're doing a poor man's covered call, it's only your max loss is how much it costs to open the option. It's $295, which isn't that much. That's not a huge discrepancy from, or it is a huge discrepancy from the amount you probably could put into the option, which is $1,200. And your max profit also drops, but you can see that, just getting into that option is pretty important, because if Amazon goes up, yeah, you could make more theoretically, but also you're not protected on that downside. So in this scenario, you can only make $200, but you can only lose $295. So you're not losing that full $1,200, but you're not making an infinite amount of money if Amazon keeps running up, which some people might feel like they miss out if they don't get that chance. But personally, I'm happy with making any money at all. So I'd be very grateful if Amazon did just go up as a whole. I'd be very happy. But this is a play that I'd personally make. I think that Amazon is going to go up in the next 47 days due to what's going on with their company, where the market is right now. And I think that this, it's not that expensive to get a call on Amazon for $295. I'd take that, every single time. That's, as far as that goes, it's not that bad. And then you can see right here, this is another example. This is the max loss of a poor man's covered call. So the max loss formula is the trade cost. You can only lose what you're putting into the trade. So you can see that the trade cost on this is they are buying 100 contracts of Apple, their calls in the money, for $27.65 each. So times that by 100, you move the decimal place twice. That's $2,765. And then they're selling a covered call of Apple where they're getting paid a premium, which is $310, because you times this by 100, move the decimal place twice. So you can see their max loss is $24.55 a contract, but since you're buying 100 contracts with the options, your max loss is $2,455. And just a little bit deeper on, so the cost to open a call is $27.65. This is, relatively expensive as far as options go, but opening calls is very expensive, and then they're selling a call against that. And when you sell an option, you get premium for selling the option. And basically when you do sell that option, if we go back here, you can see you're selling a call right here for $332 for those 100 contracts. And the price that you see when you're selling a call is the premium that you're getting paid to agree to sell the stock at that price. So you're agreeing to sell SPY if it hits $625 for $332 in premium. So if SPY blows above that, you have to sell it for $265. If it doesn't get there, then you don't have to sell it. You can keep it. So that's a very interesting thing as well. We can see also right here, or we already have the play I'd make, but this is another play, or this is another thing that I wanted to point out, is that you can also, so they're called poor man's covered calls because you can only make covered calls if you own 100 shares of a stock, because options are 100 contracts. So in order to sell a call on a stock, you have to own 100 shares of that company, which is hard for, a stock like SPY. You'd have to own 100 shares of SPY, which comes out to around $62,000, and then you'd sell a call on it that's, the premium is almost 300. So they're not very comparable, the two. But if you did get to that point where you're holding that much SPY and you get to sell calls on it, that's amazing. That's how, that's what a lot of financial advisors do, actually, for famous, influencers, people with a lot of money, basketball players, baseball players, football players. A lot of them actually do sell covered calls in their portfolio. And that gains them, they're beating the market by selling these covered calls. And, sometimes it blows past their covered call price, but sometimes the stock will drop and the covered call will be the best play ever made. You know what I mean? So yeah, I mean there is a lot of things that you can do with this covered call method, but I'd say that, and they're called poor man's covered call because you can't afford 100 shares. I can't afford it either, but 100 shares of the company. So you're buying a call that is going to expire eventually, but this is taking place of owning 100 shares of the company, and this call is acting as collateral to sell the call for $284 in premium that you're selling. So you're selling a call against your 100 shares, but if you don't have the 100 shares, you have 100 contracts to buy the stock at that price, which are pretty much shares. The delta is almost 100 on, or owning a share is almost 100. But yeah, I mean, they're pretty comparable, but that's why it's a poor man's covered call. And it is riskier because they do expire eventually, obviously. But if you can own 100 shares, you should, obviously. But I mean, stocks like this, you can't, and you want to get into these plays and make this money, then you're gonna have to do the poor man's covered call method. But yeah, guys, that's all I have for today. If you did like this video, don't forget to smash the like button, and also subscribe to the channel. I'm gonna be coming out with a video every single day. This one was about options trading. I'm also going to be coming out with some crypto videos, some more stock videos for sure. And yeah, I mean, there's a lot in the works for what I'm going to be putting out. So let me know in the comments down below what kind of videos you guys would like to see. Last video was about BBAI. That was an AI company that, I think has a lot of potential. So if you haven't seen that one, go check that one out. And also, yeah, if you enjoy that, be sure to like that one too and subscribe to the channel. But I mean, this is a whole different video, but I do want to reiterate that BBAI, I think that's their ticker symbol. It's Big Bear AI. I think that company is very good and going to be very good in the long run. And it's worth just buying a share. Just buy a share or two. They're around $6. But yeah, guys, thanks for watching. Again, like, subscribe, comment down below. I'll catch you in the next one. Peace.